Hi guys, Harry Yotis here. I've been a professional trader for 20 years now, started my career way back in 2005, and for the past 10 years I've been trading my own account. So let's get started. Today, I'd like to talk about canopy growth, CGC in the States, weed in Canada. Okay, it's important to talk about this trade. It's basically my profile or my process in entering trades and then managing trades. Okay, it's very important because sometimes things don't go your way, and sometimes they do. But it doesn't matter if you stick to the fundamentals. You will, in the long run, win way more than you lose. Okay, so let's recap the canopy growth trade. Why did I choose to buy canopy growth? I mean, if you look at the chart, nothing but destruction all the way down. You can't even see it. It's a piece of crap. It's been in a sideways market the entire 2025 and in a downward trend all the way before that. Okay, with brief spikes. Okay, we mentioned why, because of rescheduling news. Okay, so why did I want to buy this stock? Basically, it comes down to, I'll recap part one. It's basically this earnings report right here. Okay, I've been watching this sector. This stock is the leader. So this earnings report we were expecting to lose 11 cents right here per share, and we basically lost nothing, or we basically broke even. Okay, not only that, this is a very, very good sign. So it's going from loss making. Look at all these negative green earnings. Okay, minus $1, minus 77 cents every quarter, minus $1. This is the first quarter that it actually broke even, okay? So this is why, fundamentally, this is a very important point in the company's career, let's say, okay, or history. The other thing is that it averted bankruptcy. You see, when we talk about building a fundamental thesis first for the stock, we want to look at the company itself and whether it's strong and making earnings. Okay, so obviously it's been losing money, but for forever. But this is a sign that it could be a potential turnaround play. Okay, so one of our catalysts right here that we built after this is that this stock right now, our first catalyst was bankruptcy has been averted. It was a question mark. All of these were question marks before. We built these afterwards. I had the first three in the first step, and I built these other three later on. To discuss how I go about making a trade. Okay, so the first step here, bankruptcy has been averted, because after this earnings report, you see that it has enough cash. Not only is it breaking even, but it has enough cash now to fully pay off its outstanding long-term debt and then some. Okay, it even bought MTL, a Montreal weed company, after this announcement. So it has enough cash, and it's still. It averted bankruptcy, but it did so at a heavy cost. Okay, it diluted its shares a lot. So that capped the upside. However, the upside, we can still go to, at the current price of $1.19, we can still go to like 15, 20 bucks if all things in our catalyst list are hit. And maybe even more, you never know, if over time positive news keeps happening. Okay, so here we entered it around this level, around the 110, 115 area. And then we got the rescheduling news, okay? So what happened after the rescheduling? Pre-rescheduling, the stock was being pumped up all the way to $2. And $2 is a key technical level, okay? We don't really look at technicals except if they support our fundamentals. We have to have a fundamental reason to enter something first, okay? And here are the reasons, the fundamental reasons, okay? And that's why we entered the stock. Not because it's breaking above 2, because if it's breaking above 2 and none of these things were achieved, I'm not buying the stock. Okay? So we built up a list of fundamental reasons why we own the stock, and then we hold it. Okay? We write it down. It's important to write it down because this is just one trade of many that you're going to make. Okay? And this is a kind of trade where it's it's long term, and it's very, very binary. This company is either going to go bankrupt or it's going to go up 10x minimum. That is your goal. You're not there to get a double or a triple. You want to really hit a home run with these types of trades, okay? Especially since it's trading at bankruptcy levels and the stock is improving, okay? So that's another thing. You build up a fundamental list and then you check it off. Has bankruptcy been averted? If it's no, then we're not buying this stock. Okay. Has rescheduling happened? If it's no, we're not buying this stock. I don't care if it's cheap. It's irrelevant. Okay. But here we have 2 out of our potential 6 catalysts that have been hit. So the story is getting better. They're literally answering questions. They answered our first question positively, and they answered our second question positively. So what else is there? We have a number of other catalysts that we wrote down. And if they keep getting checked up, you want to buy this stock. Okay. That's why we don't care about the technicals as much. This is like some kind of machine driven, or who cares what the short-term reason is. It's really irrelevant. The price has gone down, okay, while the fundamentals have improved. That's why I've been buying more. That's why I've been saying on Twitter that I'm buying more. And I'm waiting for this gap here, if you can see it. Now we enter the technicals. I'm waiting for this gap here to fill. If this gap goes down to like 113 or 116, okay, which is very close to being filled. I bought a little on Friday, but I'm going to buy even more when it comes to here. How much? We'll get to it, okay? So here you have a classic story of let's see here. The fundamentals getting better, okay, with the technicals getting worse. This is when you should be buying. This is like a gift to you, okay, because nothing has changed. In fact, things have gotten better. So as a trader who is fundamentally based, you built up a fundamental thesis, and then if the story keeps getting better over time, you buy more. This will be reversed as the story keeps getting better. Is the 7-year bear market over? We don't know. This could be the first sign of it. If we continue going forward and the earnings keep getting better and we keep getting industry news that other players are starting to make money, the industry now is not going to be in oversupply, it's going to be in fairly balanced, then we could put a check mark on this one. We also have earnings profitability achieved. Has it been? Well, here we saw that it just broke even. We would like to see this, the earnings, go turn positive. Even if it earns just like 5 cents or 3 cents the next time, okay, in February. Okay, every quarter, if it gets better, then we could check off number 4, earnings and profitability are achieved. This is literally our turnaround play that has turned around. Okay, the 5th one would be more political legislative wins, like if more people get behind this. If the alcohol lobby loses, because the alcohol lobby is fighting against weed rescheduling. Okay, they're fighting against weed legalization. Okay, if we get here the Safe Banking Act, will make it very easy for weed companies to, have bank accounts. It'll be a game changer. Okay, and the 6th one is miscellaneous, because we don't know what other things can come out that could be negative or positive, and we write it down. Every time something happens, we check off our list or not. And if the situation gets better and the price is still down here, you buy more. Okay, that's how I trade. This is how this trade is basically now. The reason why the fundamentals matter and why the technicals support it is because at this level, it's trading at bankruptcy levels. You're literally buying the stock at $1.19. Worst case scenario, it goes bankrupt, you lose $1.19. Best case scenario, legalization happens, political wins start being achieved, it gets profitability, etc., etc. In other words, the catalysts are being met one by one. This is going to be go to $10, $20, and if legalization happens, what, in 3, 4, 5 years, maybe 10, it's not going to 10. It's going to 30x, 40x, 50x. Okay, this is like if legalization happens, a long way down. But that's how you have to look at things. Like the risk reward here is so good. It's not guaranteed. Like tomorrow, maybe it's going to start going bankrupt, taking on more debt, or maybe Trump reneges on the rescheduling. Then we're out. We took a loss. It's over. Okay, but as long as the fundamental picture keeps improving and the technicals are down, I'm buying more. How much should you buy? That's the key. That's the next step. How do you structure this? Well, you do not buy options. You don't have to buy options, buy call options, waiting for the big hit, buying a April or May, January, whatever, not January too close, but a 6-month call option on $2, okay? Maybe it'll trade at 50 cents, okay? You don't know, because you don't know when it's going to happen. The stock is cheap enough now for you to buy it outright. The stock itself is the option. It's a perpetual option that will never expire, and you're getting it for $1.19. That's how you should look at it, okay? So don't buy the, unless I've also been selling options. I've been selling the April and June or July $1 puts, because I want to get it for 20 cents. So it's like I'm buying the stock at 80 cents. And if it doesn't happen, I'll collect a 19-cent premium. It was 19 cents, I'm sorry. So there's ways to get to use options, but not to buy speculatively, like 3-month options and expecting it to rip in 3 months, because you're going to probably lose, and then maybe win once. Who knows? Maybe you'll like shy out of the trade after 2-3 times that you do this. And remember, this could be a 3 to 10 year play, but you don't care if it's 10 years. This reminds me of the uranium play in 2018 when I bought it, nobody wanted it, and then it took 5 years to pan out. Okay, but you're making 5 to 10x. If you're making 10x return in 5 years, you're better than Stanley Druckenmiller, than Soros, than all of these guys. Okay, so, and the most important thing now, well, that's not the most, but the most important is the initial fundamental reason to enter it. However, after that is managing the trade. As it's going down, you want to buy more. Okay, but how much do you buy? That's the thing. Okay, you do not want to allocate more than 3 to 5% of your entire portfolio on this trade. Okay, I'm going to write it down. Allocation 3 to 5%. Nothing more. Don't go nuts. Because if all of these get achieved, then you get a 10, 20x return. A 5% allocation will give you a 100% return on your portfolio. Okay? I currently have about a 4. I'm going to get a 5 if it ever drops back here, and I'm going to allocate up to 5%, and that's it. Okay? And if things keep getting better, in 5 years, you might get a 30, 40, 50x if we keep getting better legislative news on the political front, and profitability is happening, and the 7-year bear market is over. This is a long-term trade that can really, really change your account. Okay? And you don't need more. 3 to 5%. If this company now, if you allocate 3 to 5%, and this company all of a sudden is going to go bankrupt, and the rescheduling gets, for whatever reason, there's a kibosh on it and it disappears, you only lose 3 to 5%. I can make that up in a month. It's no problem. You're not dead. But if these fundamental catalysts do happen, you're going to have an account with a 4% allocation, let's say on average. You're going to have a meaningful return. It bites. It'll bite. It'll turn the needle. If you have a 4% allocation and we get a 20x return, you just made an 80% return on your entire portfolio on a 4% allocation. You can sleep at night. This is a fire and forget type of move. Okay, so again, let's reiterate. Okay, what matters most is the fundamental reasons for getting into something. If the technicals go against your fundamentals and the fundamentals are getting better, you want to buy more. It's when you get greedy. Okay, I wouldn't be saying this if the fundamentals were getting worse and the price was going down. Okay, that's why to me it's worth it as a trade to take a 3 to 5% allocation of your portfolio into this with stock. You don't need options. You can sell puts if that's what you want, but you should also have physical shares along with selling puts. Okay, because if you keep selling the puts, and you can get some kind of income. Okay, but it's not how you're going to make the crazy money. The crazy money is buying the stock outright. Okay, you don't have to worry about options. Forget buying, going long calls, especially since the IV, the implied volatility right now for canopy growth is high. That's why you want to sell premium. It's about 150% volatility, implied volatility in the stock, so in the options. So you want to be selling. You don't want to be buying calls at this point. You want to just buy the stock. It's that simple. Okay, and now we manage it. Is the fundamental story getting better? Do we check off? And by the way, important thing, write it down. You're going to forget in 3 months, 6 months, 7 months, you're going to be making 200 trades. You're going to get 100. You're going to forget about this. So you're going to forget about all the reasons you bought it. That's why you have to write it down. I'm writing it down. It's right here. And it's on and I write it down old school on paper. Okay. The allocation is automatic. I already know how much I'm going to have. Okay. So I write this down with question marks behind it. And if they get achieved positively, they get a check mark. If it's negative, down, thumbs down. Okay. What if they don't get profitable going forward? Okay, what if it gets complicated? What if their profitability is 0, but they're getting political wins, like they're going to legalize weed soon? Well, then you have a choice to make. It's not cut and dried, okay? You're not going to get, it's not going to be the perfect scenario where everything gets a yes check mark. Sometimes you could have a mixed couple of check marks, 2 or 3 check marks on the yes side, and 2 or 3 thumbs down on the no side. Then you'll have to make an audible. You have to make a choice of what you want, okay? So, but it's always going to be driven by the fundamentals, not by the price action. Understand? So, that's what I do when I enter a trade, okay? The step-by-step process is first the fundamentals, then basically, you don't even have to look at the technicals with trades like this. You just look at the price and you have a great risk reward, But generally, when things aren't this cut and dried and binary, where the stock either goes bankrupt or gets a 10, 20, 30x return, normally you don't have these kind of situations. What you have is you have a fundamental reason, and then you look at the technicals to enter the trade. Okay, that's it. And of course, you allocate 3 to 5% in these trades, no more. You can sleep at night. It's plenty of leverage to have a meaningful bite in your portfolio when the move happens, and you can sleep at night. So that's how I approach trades. Fundamentally driven. The technicals are the last part, and then you manage it by seeing it, if your Santa Claus list has been checked as the things keep happening, as these questions that you wrote here get answered, hopefully positively. So that's it, guys. That's a little overview of how I look at trades, not just for Canopy Growth. I do this for everything. So just a little sneak peek on my process. So I hope this was informative for you guys. If you liked it, just like and subscribe. And of course, comment below and I will answer your questions as soon as I can. Thank you very much.